Hi everyone, my name is Kushigera and I'm your ACCA tutor. Today we are going to learn about how to calculate taxable income of an individual. This is part 2 of the basic income tax series. So let's move forward with it. Now, an individual has broadly three types of income: non-saving income, saving income, and dividend income. Here we have a basic performer of how to calculate a taxable income. Obviously, we are going to learn everything in detail, but to get you just a gist of how to do it in your Excel or on a proper format, this is how we do it. So non-saving income includes these first four types of income. First of all, your trading income. Trading income is your profits from business that you run as a sole trader, or the profits that you have gotten from your partnership business if you are a partner there. The profit share that you've gotten from your partnership business. Then we have employment income. This is your salary that you get from a job that you do, be it part-time, be it full-time. Then we have property income. Property income is rent received from the property that you have let out to the tenants, be it a residential property such as flats or house that you have given to tenants to live there, and it can be a non-commercial property as well. For example, that you have let out a place to a supermarket where they have opened their stores. Okay, non-commercial let out means that you have let it to a business for the purpose of conducting their business there. Then pensions. Now people who have retired and who receives pension um, are also going to be taxed on the pension income under non-savings income. Then we have building society interest, bank interest, and other interest. All these type of interests are a part of my savings income. So first of all, bank interest, the easiest one of them all. Bank interest is the interest that you receive on your deposits on your savings account that you keep in your banks, such as in HSBC. If someone has opened their bank account and they put their money there in a savings account, every bank gives interest onto the deposits every year. So that interest is also a part of my savings income. Then building society interest. Now building society is a similar organization to a bank where you can deposit your money and they will give you interest on it. So it is not exactly a bank, but the structure of building societies is just like a bank where you can deposit your money and you will get an interest on it. And other interest includes, for example, let's say you have lent money to your friends or family or someone else, or even let's say to your friends, to your business partner, anyone. So if you receive interest onto the loan that you have given, that is also a part of my other interest under savings income. And then we have dividend income. Now dividend income is dividend that you receive from your investment in companies, be it public company, be it private company. Every company uh, that you invest in might give you a dividend. It's not compulsory for every company to give a dividend, but most of the companies which have spare cash left in their business gives out a dividend to the shareholders. So if you have invested your money, if you are a shareholder in that company and the company gives out dividend to shareholders, you will receive a dividend, and that is going to be taxed as dividend income in your computation, in your total income computation. Sum of non-saving income, saving income, and dividend income gives you total income. Okay, now one thing you would say that why are we writing all these three, why are we making three different columns for three different types of income? The reason behind this is different tax rates. All of these three have different tax rates. That is why it needs to be they need to be written separately in separate columns. So when I tax them, I can put on the separate rates according to which type of income it is. Okay, so sum of these three gives me total income. From total income I will subtract my reliefs, then I will get my net income. Now what are reliefs? First relief is trading losses. Trading losses is such as in trading income you receive profits from your business. So in a scenario, if you have a loss from your business, you can subtract it from your total income and you can get your net income. It means that if you have incurred a loss in the tax year rather than a profit, you can subtract it from your total income to reduce your taxable income, to reduce the income on which the tax will be charged. Okay. Next, we have qualifying interest. Now, qualifying interest are the interest payments that you make if you have taken a loan for the qualifying purpose. We're going to learn later on what the qualifying purposes are, but for now, you need to understand that any interest paid on the loans that were taken for the qualifying purpose can be subtracted as relief. And if you have incurred a loss in your business, be it a loss from your own business as a sole trader or a loss from a loss share that you have gotten from your partnership business, can be subtracted here as a relief. After deducting my reliefs, I get my net income. From net income, I will subtract my personal allowance. So the limit maximum personal allowance that is available to an individual is 12570. This is the maximum personal allowance that is available to an individual during a particular tax year. Okay, it will be subtracted from our income, and after that we'll get our taxable income. Now, personal allowance can be reduced from we can reduce the personal allowance amount in certain situations. We have to reduce the personal allowance amount, but it cannot be increased more than 12,570. It's the maximum amount available of personal allowance to everyone. Short form for personal allowance is PA. Alright, so we have learned the basic performer, that you take your non-saving income, you take your saving income, you take your dividend income, you get a total of it, which is total income. We minus our release. Release include our qualifying interest and our trading losses. Then we get our net income, and after subtracting personal allowance from net income, I will get my taxable income. Okay, now before moving forward, I will tell you one more thing, that any reliefs and personal allowance needs to be subtracted in the sequence of first with the non-saving income, then with the saving income, and if left with the dividend income. Why so? Because non-saving income has the highest tax rate and tax bracket. Therefore, any relief, any personal allowance needs to be first subtracted from our non-saving income. If left, then with the saving income, and if left, then with the dividend income. All right, it should always be in the same sequence for relief as well as for personal allowance. Let's move forward. Now, some of the incomes are exempt as well. Exempt means that there will be 0% taxes on them. Like, it is a tax-free income, you don't have to pay any taxes on it. Okay, so first type of income that we have is betting and premium bond winnings, basically your lottery and gambling. Zero taxes. Then interest on national savings certificates, interest on NSNI certificates. Okay, NSNI certificates are an investment or an investment option that is given by the government, where individuals can invest their money in, and any interest received onto them will be tax free. Then any scholarship that you have earned, either for your professional degree or for your graduation, masters, anything is tax free. Statutory redundancy money. See, when an employer removes an employee from the organization without their own fault, or because the job is no longer required, they are required to give the employee a fixed redundancy money, which is which is legally required for them to pay to the employees. That is also tax free for the purpose of taxation from employees perspective, because they are receiving the money, right? Then income from individual savings account, again a type of government investment. Okay, where you invest your money and any income received from it is going to be tax free. Now, individual savings account are of broadly two types: cash ISAs and stock and share ISAs. There are four types, but in our syllabus, we are going to learn that they are broadly of two types: cash ISAs and stock and share ISAs. Cash ISAs are just like your savings deposits account, where you can deposit your money and you will get an interest on it. Whereas shares and stocks ISAs are the one where you put your money and you will get a dividend. Okay. So these are the type of income that you can receive from your ISAs. Both are tax free. The maximum investment for a particular tax year that you can do in ISAs is 20,000. Cumulative of both of them, not 20,000 each in cash ISAs or stock or share ISAs, 20,000 in both of them. You should not invest more than 20,000 in ISAs, cumulative of both of them. Okay. Now, and if let's say if you withdraw your money from stocks and share ISAs and you sell your shares at a gain, that gain is also tax free, but that is something related to capital gain tax, and we're going to learn that later. Okay. All right. Then we have qualifying interest payments. It is a relief that we subtract from our total income to get the net income. Now, what I told you that qualifying interest are the interest payments that we make onto the loan taken for the qualifying purposes, right? So that includes loan used by a partner to invest in the partnership, like loan taken by a partner to contribute capital towards a partnership or to become a partner in a partnership business, is for a qualifying purpose. Next is loan taken by a partner or employee to purchase plant and machinery to be used in their partnership or employment respectively. And lastly, loan taken by employees to invest in unquoted employee controlled trading company in which the employee is a full-time worker. What is unquoted employee controlled trading company? Employee controlled trading company is the one that is being controlled and managed by all of its employees, and they share the profits respectively. And unquoted means that it is not listed on the stock exchange. It is not a the shares of these companies are not publicly traded. Okay, now let's do a question. They say Abby had the following income for the tax year of 2023-24. Salary is 33,000 and property income is 19,350. Both of are non-saving income. On 1st February 2024, Abby took a loan for 5,000 to buy shares from Havik Limited, a company which is controlled by its employees and for which Abby works full-time basis. This is a loan for a qualifying purpose, so interest can be subtracted as a relief. The interest incurred on the loan up to 5th April was £300. We have to calculate the Abby's taxable income. Let's see. So we are going to start with non-savings income. We have salary, we have property income. Salary is 33,000, property income is 19,350. Total income is going to be 05325. Okay, 52350. Then we are going to minus reliefs, which is qualifying interest. Now, Abby took a loan for 5,000 and the interest accrued on a loan up to 5th April up till the tax year was 300. So I will minus 300, which is my qualifying interest here. I will get my net income as 52050, and then I will subtract my personal allowance of 12570 to get my taxable income. Now that would give me 52050 minus 12570. 39480 is going to be my taxable income. Moving towards next topic that we have is of personal allowance. As I told you, an individual receives a personal allowance of 12,570 each year. This is the maximum limit. It can be reduced in certain situations, but before they say that in the exam we will always set up personal allowance in the order of first with the non-saving income, if left with the saving income, and if left then with the dividend income. We cannot carry forward our personal allowance. For example, if your income, net income, is less than personal allowance, whatever personal allowance is unused is going to be lost. You cannot carry it forward to the next year and use it for the next year's income. Okay, but in certain situations, in certain with certain circumstances, you can transfer some of your personal allowance to your spouse. That is known as marriage allowance, and we're going to learn it in the next topic. Okay, so but before that, in certain situations, as I told you, personal allowance can be reduced. First of all, the step one for you should be, you need to look at whether, first thing is look at whether your net income is greater than 100,000 pounds or not. Okay, if your net income is greater than 100,000 pounds, there is a possibility that your personal allowance needs to be reduced. Okay, if your net income is greater than 100,000 pounds, second step is going to be calculate adjusted net income. What is adjusted net income? Adjusted net income is net income minus gross gifted donations. Gross gifted donations is gifted donations to UK registered charities less gross personal pension contribution. This is the pension contribution made by the individuals. We will get our adjusted net income. Third step is going to be look for whether ANI, short form for adjusted net income is ANI, whether ANI is greater than 100,000 pounds for or not. If my ANI is greater than 100,000 pounds, then my personal allowance will be reduced 50% of the excess used by the my personal allowance will be reduce personal allowance by 50% of the ANI excess above 100,000 pounds. For example, now let's take an example. Let's say my ANI comes to as 110,000. Okay, so first thing first, I'm going to look at excess above 100,000. Okay, that is 10,000. The ANI excess over 100,000 is 10,000. Then my my personal allowance is going to be reduced by 50% of this excess. So reduced personal allowance is going to be 12570 minus 50% of this is 5,000. Therefore, that gives me 7570 is my reduced personal allowance. Okay. In other terms, if you want to have a shorter formula for it, it's going to be personal allowance minus ANI whole bracket inside bracket ANI minus 100,000 inside bracket close into 50% whole bracket close. This is going to give me my reduced personal allowance. Okay, now Person with the ANI of 125, 140 or above will have 0 PA. Why so? Because the excess here is 25,140 and 50% of that is exact amount of my personal allowance, and therefore if I reduce this amount from my PA balance, my PA is going to become 0. So, in a situation where your net income is greater than £100,000, an individual should make contributions to gross gifted donations and gross pension schemes in personal pension schemes in order to make my adjusted net income less than £100,000, therefore, to a claim of the whole personal allowance available. Let's do a question. Now, here they say that Marcos received the following income in the tax year of 23-24: trading income, building society interest, dividends, and interest from NSI certificates. He also has gross donation, gift aid donations, which is gross of 2,500. We have to calculate the taxable income. All right, let's see here. So we have three different types of income. So let's take non-savings income, savings income, dividend income. Total. All right. So first of all, I have trading income, which is my non-saving income. Of 91,000. Then I have building society interest, which is my saving income, of 10,000. Then I have dividend income, which is of 5,000. So 91, 10, and 5. So therefore my non-saving income total is going to be 91, 10,000, 5,000, and the total here is going to be 106,000. Okay, so this is my total income. So as there are no reliefs here, total income is my net income because reliefs are 0. But let's show it less reliefs: 0, 0, 0, and 0. So therefore my net income is same as my total income. But here you need to look at one thing, that your net income is greater than £100,000. So we need to calculate adjusted net income to see whether my personal allowance will be reduced or not. Alright, let's do the calculation here. ANI is calculated by taking our net income, which is 106,000 minus gross gifted donations. There is no gross personal pension contribution. Aid donations minus 2,500, that gives me 103,500. Yeah, 103,500. This is my ANI, and I told you I will reduce my personal allowance by 50% of the excess above 100,000. So excess above 100,000 is 3,500. So therefore my reduced personal allowance is going to be 12570 minus 3,500 into 50%. Therefore that gives me 3,500 into 50%, 10820. My reduced personal allowance is 10820, and as I told you, personal allowance is subtracted in the sequence of non-saving, then savings, and then dividend income. So therefore all of my personal allowance will be taken up by my non-saving income, and this will give me my taxable income. So taxable income here is going to be 80180. Here it's going to remain same, here again same, and as for the total it's going to be 106,000 minus 10820, 95180. I hope this is clear. Now let's move on to our next topic of marriage allowance. As I told you in the topic of personal allowance, that in certain scenarios an individual is allowed to transfer some part of their personal allowance to their spouse or civil partner. Now you will ask, what is civil partner? Civil partner is similar to a person who is a spouse. So civil partner is a person when you're not legally married to someone but you're living with them, and you can register yourself as civil partner in the UK. You will get the same benefits as a spouse gets. Okay, so an individual can transfer some part of their personal allowance to the spouse or civil partner. That some part is fixed. Okay, an individual can transfer a fixed 1260 of their personal allowance to their spouse or civil partner, but if they transfer this amount to their spouse or civil partner, it will reduce their own personal allowance. For example, let's say Rai and Tia are civil partners. Okay, Rai wants to transfer, Rai elects to transfer her PA to Tia. Okay, so Tia will get an additional personal allowance or a marriage allowance of 1260, whereas Rai's personal allowance will be 12570 minus 1260. 11310 will be for Rai, and Tia will get 1260 plus 12570. So if you're transferring personal allowance to a spouse or civil partner, it is going to reduce your personal allowance, and it is going to be added as marriage allowance that can be subtracted from the net income. Okay, now we have learned one thing, that a fixed amount can be transferred, which is 1260. Okay, there is again a condition onto it, that both the partners, both the spouses or both the civil partners, should be basic rate taxpayer. Basic rate taxpayer. What does it say? That both of the spouses or civil partners' income should fall under the tax bracket of 20%. Okay, this is the tax rate for basic rate taxpayer for non-saving income and saving income. Okay, and the limit for basic rate bracket is 37700. So they want to say that both of the spouses should have their income falling under 37700, otherwise they will not be entitled to get a marriage allowance. Okay, next thing is, an election needs to be made if they want to transfer the marriage allowance, and they cannot reduce the amount that needs to be transferred. It is fixed. If they want to transfer, fixed 1260, otherwise do not transfer it. Okay, and therefore, as I told you, that both of them needs to be a basic rate taxpayer. Therefore the maximum Reduction in the tax liability that can be taken would be at basic rate itself, because both of them are basic rate taxable. So the maximum tax advantage that an individual can get from deducting the marriage allowance from their net income would be at basic rate taxes. Okay. Now, as I said, an election needs to be made in advance. In advance means before the tax year ends. So our tax year is from 6th April 2023 to 5th April 2024. So if you are making an election in advance to transfer the marriage allowance, it needs to be done before my tax year ends. It means before 5th April 2024. And it is assumed that if you make an election in advance, it is going to remain in force for the foreseeable future until either you withdraw the election or the conditions of the election are no longer met. It means that either you or your partner is no longer a basic rate taxpayer, or both of you are not no longer a basic rate taxpayer, then the election is forfeited. Next is, if you are making election in arrears, it means that you get to know after certain, let's say you get to know after 2 years that, oh, you should have transferred your personal allowance to your spouse to take advantage of that leftover personal allowance for you to take advantage of it. And you get to know it after 2 years of filing the tax return in that particular year. For example, I filed my tax return for this year, and I get to know after 2 years that I could have transferred my personal allowance to my spouse and could have taken advantage of that, and could have paid reduced tax liability as a couple. Okay, now it means that I am making that election in arrears. First of all, you have limit of 4 years to make that election after the end of tax year. It means after my tax year ends, I have 4 years to recognize that I could take advantage of marriage allowance and make an election for it. If 4 years have already passed, then you cannot, you know, make the election of taking advantage of marriage allowance. And if I make an election in arrears to take advantage of marriage allowance, it is for the particular year itself. For example, my tax year this year is 5th April 2028, and after 2 years, 2024, after 2 years, I get to know that I could have taken advantage of my marriage allowance. So it means if I am making an election to take advantage of marriage allowance for this tax year after 2 years, so the election is only for this tax year. It means I will only be taking the election. I will only be making the election to transfer the marriage allowance for this tax year. Let's write it down. Let's say I filed my tax return for the year ended 5th April 2020. Okay, I have 4 years after this tax year to make an election to utilize MA or to transfer PA for this year, just for this year, no year before this, no year in between, no year after, only for this year. Okay, means that if I, later on review my tax returns and get to know that I could have taken advantage, I have 4 years after the end of my tax year to take advantage of that. Okay, now 4 years here would be 5th April 2021, 5th April 2022, 5th April 2023, and 5th April 2024. It means I need to make an election before or by 5th April 2024 to take advantage of marriage allowance in this particular tax year. And how will you get the benefit of it? If you have already paid your tax liability, you will get a refund, or it will be adjusted in your current year income tax liability. Okay, but the thing is that election will only be for one particular year, not 1 year before that, not any year in between, not any year after. It will be just for one particular year. If you want to make election for further years, you need to make it separately. All right, now let's do a question on it. They say that Rasmus is on a career break to enable him to care for his young children full time. His husband David is a sole trader. Ramses make an election to transfer the marriage allowance to David. Has trading income of 28,350. Ramos has no income at all. So both of these are basically taxpayer. It means their income is falling under 37,700. That's my basic rate tax bracket. We have to calculate taxable income for both of them. Okay, so Rasmus has no income, so no taxable income. We are going to do it for David. So David has only one income, trading income, which is a part of its non-saving income. So let's write down trading income, which is 28,350. Then we have nothing else. So trading income is David's total income. No release. So total income is my net income. So now David has a personal allowance of 12570, but David also has a marriage allowance of 1260. So therefore David's taxable income is going to be 28,350 minus 12570 minus 1260. 14520. Okay. So this marriage allowance has reduced David's taxable income by 1260. Alright. Alright everyone, let's move to the next question. Now, here Maya received trading income of 25,000, building society interest of 5,500, dividend of 2,500, interest from ISAs which is exempt, and bank interest of 780. Now, I think I forgot to tell you one thing else, that whenever an income is exempt, you do not eliminate it from your calculations. You write the value as 0. We include it in our taxable income computation, but we include it as where the value is 0. All right, let's see how do we do it. Now Maya has trading income, which is my non-saving income. Then I have saving income, dividend income, and total. Okay. Here my total is going to be trading income as 25,000. Going to write it under total as well. Then building society interest is my savings income, which is 5,500. Then I have dividend income, which is going to be part of dividend income under here as well. Then we have bank interest, which is again a part of my saving income, as 780, and then interest from ISAs. Even though it is exempt, we are going to include it in our total income computation, but we are going to keep it as 0. Okay, because in the examination, even if something is exempt or is not included in a part of your computation, you should write it and write the value as 0, because it is going to be marked by the examiner. Okay, Therefore, my total income comes as 25 here. It's going to be 550 plus 780, 1330, 2500, and last year we have is total is going to be 28830. Now, as Maya is a basic rate taxpayer and we assume that her civil partner is also a basic rate taxpayer, so she will be eligible for a marriage allowance. But before that, let's subtract reliefs. Here our relief is interest on qualifying loan, right? So again, reliefs are first subtracted from our non-saving income, so it will, all of it will be consumed by non-saving income. After reliefs, I get my net income. Net income here is going to be 25 minus 1090, 23910, 1330, 500, and 28830 minus 1090 is going to give me 27740. Then I'm going to subtract my personal allowance and marriage allowance. So first of all, less personal allowance. Personal allowance will also be consumed by first non-saving income, and it is not left for other incomes. After that, less marriage allowance. Again, first with the non-saving income, 00000, 12570 and 1260. Therefore, the last, my taxable income is going to be, for non-saving income, it's going to be 230 minus 12570 minus 1260, 10080, 10080. Savings income and dividend income are going to remain same, 1330 and 2500. And lastly, we will have minus 12570 minus 60, 13870. Again, let's do a quick recap. So we take a sum of all our incomes: non-saving income, saving income, and dividend income. That gives us total income. Then we subtract our release, which includes qualifying interest and our total trading losses. After subtracting reliefs, I get my net income, and from net income I subtract my personal allowance, and then I get my taxable income. And if my net income is greater than £100,000, I need to check what is my ANI, adjusted net income. If your adjusted net income is also greater than £100,000, then your personal allowance is reduced by 50% of the excess ANI above £100,000. And there is something known as marriage allowance as well, which means spouse or civil partner can transfer a fixed 1260 pounds of the personal allowance to their spouses, and that can only be done if both of them are basic rate taxpayers and an election needs to be made to make a transfer. Alright, I think that sums up the total of how to calculate your taxable income. In the next video, we're going to learn about how to calculate the income tax liability. Alright, that is it for the video, guys. I hope you understood everything. If you like the video, do leave a comment under the comment section and let me know. That's all. Bye-bye.